Fundstrat wrote on their X account. Powell today at Sintra confirms the Fed acknowledging softer inflation, a contrast to the FOMC meeting. Powell's comments at Sintra were acknowledged by the Fed that recent incoming reports, starting with May ISM prices paid to May CPI and PCE, all show a consistent picture of weakening inflation. Fundstrat and Tom Lee also share this picture of inflation that is falling like a rock. And let's take a look at this data today that is pushing markets to all-time highs. ISM Services PMI for the month of June came in at 48.8. You were expecting 53.5, so that was a miss on the headline numbers. ISM Services business activity came in at 49.6. You were expecting, get this, 61. So with your ISM Services number, with any of your PMI data ever, anything above 50 is positive, is expansionary. Anything below 50 is contraction. So we were expecting business activity to expand a lot in June, and it actually contracted. So from that standpoint, it's not a great sign for the economy. But yes, it is very disinflationary. ISM Services employment came in at 46.1. You were expecting 47, so that was a little weaker. ISM Services new orders came in at 47.3. You were expecting 54. Again, disinflationary, but also bad data for the economy, right? And the two normally go hand in hand. Economy gets worse, disinflation starts to pick up. That's how things tend to go. So this is bad news for the economy, good news on the inflation front. And then finally, you had ISM Services prices that came in at 56.3. You were expecting 57.8. So that was also lower than expected. So I guess the question is that I have for you, is the economy weakening good if inflation is falling, or inflation running a little hotter but the economy doing well? What's better for stocks? Today, you did have initial jobless claims that came in at 238,000. This was 3,000 higher than the 235,000 number we were expecting. Continuing jobless claims came in higher than expected as well. And if you take a look at the chart of continuing jobless claims, there has definitely been an upside, rise here over the past year. This is looking at the last year. So you're definitely starting to rise. Looking at the past 3 years, definitely starting to rise on a 3-year basis as well, hitting the highest continuing claims that you have seen in the last 3 years. So it is obvious the labor market is starting to weaken. But on the other hand, you did have the ADP employment change. This is the private payroll number that came in at 150,000 jobs. You were expecting around 100 for the forecast, and consensus was around 160. Also had exports that missed by about $4 billion and imports that missed by about $4 billion as well, which did cause the Atlanta Fed GDP Now tracker to lower the Q2 GDP estimate from 1.7% to 1.5%. The bottom line of this data today, weaker economy, weaker inflation, labor market that's holding up. That could be a good recipe for stocks. Now, I think part of the problem is for the people that are uber bulls is valuations are super high. So especially as we head into earnings season, the expectations are just too high. There will be some disappointments. There will be some questioning of, are expectations too high? And that could cause some selling in markets. Also, it's worth remembering this is an election year and it looks like things are getting pretty weird. It's being reported that Vice President Kamala Harris past donors are privately strategizing in case Biden drops out. Also reported about an hour ago that Biden told an ally that he is weighing whether to continue in the race. And the simple fact of the matter is, markets will not care who wins. If one wins over the other, then sure, that could be a little better or a little worse. After the election itself, the uncertainty will be over. But from now until then, there's a lot of uncertainty. Who's even gonna be the runner-up to Trump? Who's gonna try to compete with Trump? Is it going to be Biden? Is it going to be Kamala Harris? Is it going to be someone else? We just don't even know. And that could create a little bit more uncertainty, especially if Biden did drop out of the race, which does look unlikely at this point, but is a potential risk for markets. It's also worth remembering that the average drawdown for the S&P 500 during an election year is 13%, and we only got a 5% drawdown, and that was in Q1. So statistically, we probably will get a bigger correction at some point from now until September. And based on this data that I could find, the average return in presidential election years is about 4.4%. You normally see a drawdown of about 5% in March, and then you normally see another drawdown around September to October, sometimes starting or in August. And the average return if a Republican was elected is 15.3%, and for a Democrat it is 7.6%. But the average return after an election year is 11.28%, regardless of who wins or not. ISM Chair Miller says the June services PMI indicates the overall economy is contracting for the first time in 17 months. In June, construction industry saw the largest increase in layoff announcements as per the Challenger data, and we haven't seen a spike that large since September of 2007. Bespoke writes on X, as of this morning, betting markets are giving VP Harris higher odds of being president after the 2024 election than current President Biden. The cross has happened. And this is another way to look at the services PMI data. Everything is contracting. Supplier deliveries is slowing. That's still positive. And prices, it says, are still increasing, but overall is slowing down. Zero Hedge says on X, July rate cut odds are spiking. From what I can see, they're actually not. They're actually falling today. Now odds of a cut coming July 31st are only at 7.2%. And yesterday they were at 10.3%. Seth Golden on X says, Jerome, hey guys, more than 50% of the 75 US CPI components are running below 2% year over year for the first time since 2020. If it looks like disinflation and smells like disinflation, it might just be disinflation. This individual on X says, can the S&P avoid a crash this time? In the last 4 instances, when the yield curve inversion has gone above 70% and then back to 50%, we saw massive drawdowns for the index. We are not there yet. Jeff Bezos has just filed to sell another $5 billion worth of Amazon shares. Jeff Bezos has already sold over $7.5 billion worth of Amazon shares this year. The Great Martis on X says, warning, the Dow Jones versus the NASDAQ. Indiscriminate bloodshed awaits. It won't be long. That's because the two are really inversing each other a lot as of lately. The Dow has really just been flat and the NASDAQ has been straight up. And usually these things tend to trade alongside each other and eventually match up to each other. And again, it's being reported on Bloomberg this time that betting odds for U.S. President Kamala Harris are now higher than for Biden's reelection. This could actually cause a pretty severe downside reaction in markets if indeed Biden does announce that he is stepping down and Kamala Harris is stepping up. Why? Because that would again be a lot of uncertainty. And you can see here via Kathy Jones on X, 2-year Treasury yields plunge on the ISM services data. And 10-year Treasury yields today were down about 8.5 basis points, down to 4.35%. Sven Hendrick on X says, may you live in interesting times. SPX is an inch from all-time highs, yet BPNYA, the bullish percent index for the broader NYAD, at the lowest readings of 2024 with its RSI at a mere 24. Mac10 on X says every investor assumes that rate cuts will be bullish for stocks. When the Fed finally cuts rates, there will be a massive rotation out of stocks back into treasury bonds. Stocks have never been as overvalued relative to T-bonds as they are now. As Zero Hedge says, the last time the market was this lopsided, Lehman filed for bankruptcy, referencing the S&P 500 equal weight index relative to the S&P 500 index that is market cap weighted, being at the '08 lows. Bespoke writes on X, a very tame market reaction to shockingly weak ISM services report. In prior instances, when the headline reading missed expectations by as wide or a wider amount, the median daily move of the S&P 500 was a gain or loss of 1.1%. Ladies and gentlemen, I think something big is coming when this streak of low volatility does end. Sven Hendrick says, Fed speakers, the economy is strong and we see no evidence of recession or stagflation. And he is saying this, reposting Lisa Abrick's post that says, this is the lowest ISM services read since the heart of the pandemic. CBOE gauge of implied correlation a CBOE gauge of implied correlation for the 50 largest S&P 500 stocks has recently hit a record low, meaning the amount of stocks that are driving the S&P 500 higher is at a record low. Albert Edwards says, hang on to your hats. The Goldman Sachs points out equities usually enter a bear market when their bull/bear market indicator is this elevated, but maybe this time is different. Our chart is reporting the 2-year Treasury has now the largest short position in history. Hedge funds are now short more than 2.1 million contracts on the 2-year Treasury, the largest 2-year Treasury short position in history. Lawrence McDonald puts the ISM Services PMI data into great perspective today. With the reading we see in September of 2008, the PMI number was at 49.4. Today, it's at 48.8. He says, quote, economists have been lecturing that ISM manufacturing is less relevant. It's all about services. And this is according to Bloomberg data. And now services are getting smacked. Again, I do find this very fascinating that markets did so well today based on the economy that is presumably collapsing around us. Sentiment for the S&P 500 today is bearish at 32 over on StockTwits. And the percent of stocks trading above their 50-day moving average is 42.60%. That's actually an increase from what we've seen recently, where only about 35.5% of stocks were trading above their 50-day moving average. Option activity today in the SPY, the ETF that tracks the S&P 500, was quite negative. You had 19 different unusual trades totaling $2.64 million with a positive order value of 23%. If we take a look at this Friday's expiration, you have a put to call ratio of 1.38, so about 1.4 times as many puts than calls. You've actually seen a lot more calls start to be bought in the first couple of days of this week relative to puts. Now, as far as what to expect next in markets, on Friday, we will get the non-farm payrolls number. We're expecting 160,000 job ads for the forecasted number, and the unemployment rate is expected to stay at 4%. Any rise in that unemployment rate is definitely going to start turning some heads and making investors question if we are actually heading into a steeper downturn. Again, I'm surprised the services PMIs coming in so low today did not cause a red day, but it's also important to remember that the first 2 weeks in July are historically the best 2 weeks of any year. That's number one. But heading into the 4th of July itself, you tend to be very green into the 4th. After the 4th of July, you do tend to get more selling in markets. With the 3 days after the 4th of July, which would be Friday, Monday, and then next Tuesday, that tend to be red about 75% of the time. So if you look at historical trends, this does make sense why markets were green today, and don't be surprised if they are red coming Friday and the start of next week. Also worth mentioning, markets are closed tomorrow. My overall perspective on markets right now is the risk to reward is not even, right? The risk that stocks go up 5% from here, I think is lower than stocks falling 5% from here. I think the the risk to reward is just not great, right? I think there's a better potential reward just sitting in cash, waiting for at least some kind of pullback here. The question really is, do we just get a 5%, 10, 12% correction, or does this turn into a full-on crash? And based on the data that we're seeing now, that we've seen with ISM services, you got to start thinking about a full-on crash a little bit more. By the time the markets realize what's going on, just how weak the economy is, it might be way late to actually, discounting that risk, meaning you could actually get a pretty sharp pullback when the markets finally realize, like, hey, things are not great. And then the bigger question is, when does that happen? Historically speaking, September, October would be the best time to look out for that. But I think markets these days are pretty well aware of historical trends, and markets tend to sell off September, October. So it could even happen a little sooner than that, maybe in August, again, just because markets already know, like, hey, September, October are weak months. So it wouldn't surprise me if you actually get some weakness in August as well. Or hell, depending how that data is this Friday, that could also start some weakening in markets. Then there is a chance the Fed does start to turn more bullish or dovish, I should say, and you see a broadening out of our markets and nothing ultimately goes bad. Maybe the Fed starts to cut rates by July, maybe by September, and maybe the economy holds up. It's really hard to say right now, but this data that we did get today from ISM services is a big wake-up call to everyone, or at least it should be. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.